Investing in real estate, including house hacking, creates some special tax benefits, and perhaps none are more special than depreciation and its supercharged cousin, cost segregation. By the end of this video, not only will you finally understand how these work, but you'll also know how to use an inexpensive cost segregation study to pay zero taxes on your rental income. This video gets into the weeds, but if you've recently purchased a house hack or small investment property, what we discuss here will save you thousands in taxes over the next couple of years. I'm going to show you exactly how I turned a $700 study into $70,000 of tax deductions, and I even have a coupon code to save you $50 off the cost of your study. Spoiler alert, the coupon code's in the description, so if you just want your $50 savings, it's waiting there for you. I'm Jon Schwartz, a house hacker, realtor, and real estate investor in Los Angeles, California. I've tried to be thorough with this video, but if you have any questions along the way, drop them in the comments and I will be sure to answer. But first, the disclaimer. I am not a CPA. This is not tax advice. You should absolutely talk to a real CPA before pursuing any strategy discussed in this video. Let's start by clearing up the confusion about depreciation and appreciation, and then we'll get into how these deductions work. When the IRS talks about depreciation, they're specifically referring to the loss of value of business assets due to wear, tear, and obsolescence. Think about business computers, corporate cars, heavy machinery, farm equipment, even livestock. Over time, these assets get worn down, and the IRS lets you deduct that wear and tear against your business's profits. What's really cool about real estate is that you can take depreciation deductions even though your property is actually appreciating. Here's why. If you're in the business of renting a home, the IRS sees that home as a business asset like any other, like a car or a tractor or a cow. Specifically, the building is a depreciating asset, and in fact, it is wearing down over time. But a property as a whole is more than just the building. When you own real estate, you also own the land, everything that's on the land, and without getting too legalistic, you own the right to use the land and what's built on it. So the property as a whole will appreciate over time, even though the building sitting on it will depreciate over time. The IRS doesn't concern itself with your property's appreciation, but they do give you a deduction on account of the building's depreciation. And speaking of appreciation, I would really appreciate your liking this video if you find it helpful. Depreciation deductions are taken over the useful life of the asset, and the IRS has determined that length of time by grouping business assets into a handful of categories. For example, business computers and corporate cars are in the 5-year category, so the cost of a computer or a car would be deducted in equal increments over the course of 5 years. If your business buys a $2,000 computer, you deduct from your business profits $400 per year over 5 years. Office furniture and appliances are in the 7-year category, and tractors and livestock are in the 3-year category, and there are a lot of categories. What about real estate? Well, the IRS has determined that the useful life of a residential building, whether a single-family home or multifamily, is 27.5 years. Why 27.5 years? I have no clue. Anyway, what this means is, in addition to your mortgage. What this means is, in addition to your mortgage interest deduction, your property tax deduction, deducting the cost of insurance and utilities and maintenance, you may also take a depreciation deduction of 1/27.5 of the value of the building each year for 27.5 years. And that's the depreciation deduction. Now, we have a little bit of fine print to go over, and then we'll discuss how cost segregation supercharges this whole thing. The first item to underscore is that your annual depreciation deduction is 1/27.5 of just the building's value. The best way to determine the value of the building is by looking at your property tax bill, which will separate your property into land and improvements, which is just a fancy way of saying things built on the land. The improvements value on your property tax bill is what you divide by 27.5 to determine your annual depreciation deduction. Second item, for my house hackers, only square footage that is rented to tenants is eligible for the depreciation deduction. So if you're house hacking a 2,000 square foot duplex and the unit you live in is 800 square feet, then you would only be able to take 60% of the depreciation deduction because only 60% of the square footage is being rented. Item number 3. You'll most likely end up paying taxes you deduct when you eventually sell the property. Without getting too far into the weeds, because your property isn't actually losing any value at all, when you sell, you end up recapturing the asset's value and, in effect, paying the taxes you avoided earlier. But the depreciation deduction is still very valuable because it's always better to legally defer tax payments and let your capital continue working for you. And with the 1031 exchange, you can actually continue to defer those taxes indefinitely. One last piece of fine print. the depreciation deduction, like all rental-related deductions, can only be taken against your rental income. Real estate is so tax-friendly that profitable years are often reported as losses to the IRS. That is, you end up with more deductions than rental income. When this happens, unfortunately, you can't apply the excess deductions to your other income, namely your W-2 income from your day job. However, you don't lose the excess deductions. They simply carry forward to the next year. Deductions carried forward are called suspended losses, and you carry them forward forever until you eventually have the rental income to offset. And this is how we segue to cost segregation and completely zeroing out your tax liability from rental income. The big idea is to use some fancy tax loopholes, and I don't mean anything shady, this is how the laws are written, to generate such a massive deduction in year one that you end up with suspended losses carrying forward for years, possibly until you sell. Let me explain how this works. While a residential building has a useful life of 27.5 years, the IRS has decided that certain components of a building have shorter lifespans. For example, exterior improvements like landscaping, the driveway, fencing, curbs, these all have a useful life of 15 years. Some forms of removable flooring and lighting have a useful life of 5 years. And there's also a 7-year category, though honestly, I don't quite understand what comprises it. Nor do any of us need to know these categories well, because this is where a cost segregation study comes into play. A cost segregation expert analyzes your property to determine what components fall into what categories. That is, to segregate the costs into categories. The expert then tallies up the dollar value of the various categories, and kablamo. Once you have a cost segregation study that identifies the components that have shorter useful lives, you can deduct their value over the shorter period of time. You get more deductions earlier, meaning you get to put more money back to work sooner rather than sending it to the tax man. But then here's where shit gets bonkers. The IRS has this thing called bonus depreciation. Congress fiddles with the details every couple of years, but at least through the end of 2022, the rule is this. For anything that has a useful life of 20 years or less, you can deduct 100% of its cost in year one. So a cost segregation study, coupled with bonus depreciation, allow you to rack up a huge deduction in year one. And then suspended losses allow you to carry forward that deduction until you eventually use it all up. This is how savvy investors avoid paying any taxes whatsoever on their rental income for years. I'm going to show you what this looks like in real life, and then we'll cover how you can get your own cost segregation study at a much lower price than you'd expect. I bought my duplex in 2019, and this is my actual cost segregation study. The basis for my rental unit, that is the value for just the square footage of my duplex that I rent out, was $364,988. Of that basis, the study found $55,555 worth of components that fell into the 5, 7, and 15-year usable life categories. As part of the same study, we were able to add another $16,651 from the renovation I undertook when I bought the building. The result? Here's my actual Form 8582 for my 2019 tax return. Form 8582 documents passive activity losses, such as real estate deductions. And as you can see, I racked up $76,632 of deductions right out of the gate. With an effective tax rate close to 30%, we're talking about over $20,000 I get to keep in my pocket at least until I sell, if not longer. And how much did this cost me? Less than $700. So, mic drop, there's the magic. Now let's get practical about how you can order a cost segregation study for your property, and most importantly, how to determine if a cost seg study makes sense for your situation. Traditionally, a cost segregation study requires an on-site visit and costs in the ballpark of $5,000. It used to be that only big-time investors with huge apartment buildings could benefit. However, in the last few years, a few firms have begun offering logarithmic cost segregation studies. These eliminate the need for an on-site visit and drastically reduce the cost of the study. I highly recommend the company that did my cost segregation study, DIYcostseg.com. DIY CostSeg is an arm of ELB Consulting, which has been doing cost seg studies since 2002. ELB used their library of thousands of cost seg studies to develop a sophisticated algorithm that can produce an accurate cost segregation study of your property without a physical inspection. DIY CostSeg charges between $495 and $995 depending on the cost basis of your study. And most multifamily properties will qualify for that $495 price tag. For an additional $195, DIY CostSeg offers audit defense, which means in the very rare case that your tax return gets audited, DIY Cost Seg will conduct an on-site inspection to defend the results of the logarithmic study. And for my audience, DIY Cost Seg has created a special coupon code to save you $50 off the cost of your cost segregation study. Just enter the code HHLA on the order form for $50 off the cost of your study. That's coupon code HHLA at DIYCostSeg.com. So, is a cost seg study right for every investor or house hacker? Not necessarily, and here's how to figure out if a cost seg study is right for you. In many cases, standard deductions are enough to zero out your rental income tax liability. Take the rental income you expect for the year and subtract your annual property taxes, your mortgage interest, and your straight-line depreciation. That's the 1/27.5 that you can deduct every year without doing a cost seg study. If you've already reached zero, you'll probably be fine without doing a cost seg study and taking bonus depreciation. However, if you still have a few $1,000s of non-deducted rental income left over, as I will this year on my duplex, doing a cost seg study and taking the bonus depreciation deduction in year 1 will cancel out that difference for years into the future. And don't forget that your rental income will grow each year while your standard deductions will shrink each year. Mortgages are amortized such that you pay the most interest in year 1, then less interest each year thereafter. So that's a shrinking deduction. For me personally, spending $700 to generate $76,000 in suspended losses is well worth it. At a 30% tax rate, I only need to claim $2,300 of those suspended losses to break even, and I know I'll be claiming at least that much on this year's tax return. So if you're interested in ordering a cost segregation study for your house hack or investment property, first talk to your CPA about it, and then visit DIYCostSeg.com and use the coupon code HHLA for $50 off your study. If you haven't already, please check out some of my other videos about house hacking and subscribe if the channel interests you. I put out a new video every Tuesday. See you next week.